Imagine this. You and a group of friends all want to invest in the stock market, but none of you have enough money individually to buy a wide variety of stocks, and none of you have the time to research hundreds of different companies. So you all decide to do something smart. You pool your money together. You hire a professional to manage it, and you all share in whatever that money earns. That is a mutual fund, and it is one of the most powerful and most misunderstood tools in personal finance today. By the end of this video, you will understand exactly what it is, how it works, how it makes money, what to watch out for, and why it is used by more American households than almost any other investment out there. Let us go. So let us start with the most basic question. What problem does a mutual fund actually solve? Think about what it takes to invest in individual stocks. First, you need to research companies. Which ones are growing? Which ones are struggling? Which industries have a future? That takes serious time and knowledge. Second, you need enough money to buy stocks in many different companies, because putting all your money in just one company is very risky. If that one company fails, you lose everything. Third, you need to constantly monitor your investments. Markets change. Companies change. You need to stay on top of it all. Most regular people do not have the time, knowledge, or money to do all of this properly. And that is exactly the problem mutual funds were created to solve. So here is how a mutual fund actually works. Think of it like a giant basket. Thousands of everyday investors each put their money into that basket. Now that basket has a lot of money inside it. Way more than any single investor could put in alone. A professional fund manager takes that basket of money and invests it across a wide range of companies and assets. Instead of owning one company, the fund might own tiny pieces of hundreds or even thousands of companies. When those companies grow and make profits, the value of the basket goes up, and every investor who put money in gets their share of that growth. When you want your money back, you simply sell your share of the fund, and you get back whatever it is worth at that time. That is the basic structure. Simple, practical, powerful. Now let us talk about the single most important concept in understanding mutual funds. It is called diversification, and it is the reason mutual funds exist. Here is a simple way to understand it. Imagine you are carrying all your eggs in one basket. You trip. You fall. Every single egg breaks. Now imagine you spread those eggs across 50 different baskets. If you trip and drop one basket, you lose a few eggs, but the other 49 baskets are completely fine. That is diversification. In investing terms, if you put all your money into one company, and that company has a terrible year, or goes bankrupt, you lose everything. But if your money is spread across hundreds of companies, even if a few of them struggle or fail, the rest of your investment is protected. A mutual fund gives you this diversification automatically. The moment you invest, your money is instantly spread across many different companies. That is something most people could never achieve on their own, without a huge amount of money and time. Now let us talk about the two main types of mutual funds, because understanding this difference could save you a serious amount of money over your lifetime. The first type is called an actively managed fund. This is where a professional fund manager spends their entire day researching, buying certain stocks, selling others, trying to be smarter than the market, trying to pick the winners and avoid the losers. It sounds impressive, and on paper it makes sense. A smart professional working full-time to grow your money. But here is the honest truth. Study after study has shown that the vast majority of professional fund managers fail to consistently beat the overall market over the long term. Not because they are not smart, but because markets are incredibly hard to predict, even for the most experienced professionals. And the problem gets worse, because actively managed funds charge significantly higher fees. For all that research and management, you pay more every single year, and those extra fees compound over time, quietly eating into your returns year after year. The second type is called a passively managed fund, more commonly known as an index fund. An index fund does not try to beat the market. It simply follows the market. It owns a little piece of everything. Whatever the overall market does, the index fund does the same. No expensive manager trying to outsmart everyone. No constant buying and selling. Just steady ownership of a broad slice of the economy. And because of that simplicity, index funds charge dramatically lower fees, almost nothing compared to actively managed funds. And here is what decades of data consistently show. Over the long term, low-cost index funds outperform the vast majority of actively managed funds. Not because they are doing something clever, but because lower fees mean more of the growth stays with you. For most regular everyday investors, a simple low-cost index fund is one of the most effective investments available. Now let me explain the 3 ways a mutual fund actually makes you money. The first way is growth. As the companies inside the fund grow and become more valuable, the value of the fund goes up, and your investment grows with it. The second way is dividends. Many companies share a portion of their profits with investors. These payments are called dividends. The fund collects these payments from all the companies it owns and passes them on to you. The third way is when the fund sells investments at a profit. Sometimes the fund manager sells a stock or asset that has grown significantly in value. That profit is then distributed to all the investors in the fund. All 3 of these work together over time to build your wealth steadily. Now let me talk about something that most people completely ignore when investing. Fees. Every mutual fund charges a fee each year, just for managing your money. This fee is called the expense ratio. And even though it looks like a tiny number, the impact over decades is massive. Here is the best way to understand it. Imagine 2 people invest the exact same amount of money into funds that grow at the exact same rate for the exact same number of years. The only difference is one person is in a high-fee fund. The other is in a low-fee fund. After decades, the person in the low-fee fund ends up with significantly more money, not because they were smarter, not because they took more risk, just because less of their money was taken away in fees every year. This is why before you invest in any mutual fund, the first thing you should always check is the expense ratio. The lower the fee, the more of your returns stay in your pocket. Index funds tend to have the lowest fees of all, and that is one of the biggest reasons they outperform so many actively managed funds over time. Now let me quickly walk you through the main types of mutual funds, so you know what is available. Stock funds invest mainly in company stocks. Higher potential growth, higher short-term risk, best for long-term goals like retirement. Bond funds invest in government and corporate bonds. More stable, slower growth, good for people who need more safety. Balanced funds mix stocks and bonds together for people who want some growth, but with a little more stability. Index funds track the overall market. Low cost, simple, historically very effective for long-term investors. Target date funds are designed specifically for retirement. You choose a target retirement year, and the fund automatically adjusts itself over time, becoming safer and more conservative as you get closer to that year. Perfect for people who want a completely hands-off approach. Now let me bring everything together. A mutual fund is not complicated. It is not only for wealthy people. It is not something that requires special knowledge to use. It is simply a practical tool that allows regular everyday people to invest their money across a wide range of companies with professional management or proven passive strategies, and without needing a huge amount of money to start. The most important things to remember are simple. Diversification protects you. Low fees help you keep more of what you earn. Index funds beat most active funds over the long term. And time in the market is your single greatest advantage. Start early. Stay consistent. Keep your fees low. And let compounding do the heavy lifting over time. That is not a complicated strategy. That is just the truth about how wealth is quietly built by regular people every single day. If this made mutual funds finally make sense to you, hit that like button. Every single week we go deeper into the psychology and the truth behind money, the real stuff nobody teaches you, the stuff that actually changes how you think and how you live. Subscribe and come back next week. I will see you there.